Hello and welcome to this special coverage of the UBS India conference. And with me, I have three special guests from left to right. We of course have Tanvi Gupta Jain, Chief India Economist, Jeffrey Dennis, Head of Global Emerging Markets, and of course Gautam Chowcharia, ED and Head of India Research at UBS. So, ladies and gentlemen, thanks a lot for joining us. As we say, Atithi Devo Bhavo. So, Jeffrey, we'll start with you since you are a guest in India.
Thank you.
First of all, any difference this time when you landed in Mumbai compared to your last visit?
As busy as ever. Some suggestion of slightly worse pollution, I think it's fair to say. It was a little bit cloudier and darker, but I think what you get when you come to India is the buzz of an economy that's growing and growing pretty strongly. I'm sure we're going to debate how strongly. And also, I think it's a classic emerging market story because you're coming from a very low base in terms of income per head, so a lot of activity, but I've been here many times before, very similar to what we've seen in the past.
Oh yes, you're talking about smog, and that's really been an issue, of course, more for Delhi, but even in Mumbai, there's been a bit of a smog in market as well, Jeffrey, for emerging markets. What would you attribute that to? Or is it just that because we've been spoiled so much by markets going up, we've forgotten that markets can correct as well?
I think it's both, frankly. Markets have gone up a lot this year, of course, and the US has gone up a lot since the election almost exactly a year ago. But the point that we've made to people is that in early September, the dollar stopped falling, began to rally a little bit, and that's led to the inevitable pressure on certain countries which are perceived to have weaker fundamentals, weaker currencies. So you've seen a lot of selling in Latin America, a lot of selling in parts of EMEA, Turkey and South Africa. But at the same time, what's been very interesting is Asia has continued to do well. Now, I know you've seen a little bit of weakness in the rupee over that period, but Asia has continued to do well. So it's almost like the tech sector, which has been the big driver in emerging markets this year, and markets like China and Korea have kept going, whereas you've seen some risk taken off the table in some of these other emerging markets. And so what matters, I think, from here is what is the general trend of global growth, what's the general trend of earnings growth going forward, but also where's the house that the dollar's going to start to go down again eventually over the medium to long term, and I think that will bring that liquidity back into EM. And so we're not particularly bothered by this pullback because it's been fairly small.
It's been fairly small. There's been some concern about what's happening in China as well, Jeffrey. Of course, the US bond yield, that's something that we've looked at over the last couple of days. At what point do you think the emerging market story will be a buy story again? Is it already there? Or do you think maybe some more correction and then...
I think it's definitely a buy for the long term. I wouldn't try to be clever enough to try to pick, the actual buying point on a shorter term basis. I think that one of the things we have to absorb, which is going to be a challenge for emerging markets as you go forward, is that the Chinese economy will slow down next year. I mean, one of the interesting things about this year is the Chinese economy has been considerably stronger than we all thought it would be 12 months ago. And this has been a very big driver of emerging markets in 2017. Now, going forward, we have that slowdown forecast again, 6.8 to 6.4. And the pullback just in the last couple of days has been, frankly, because the Chinese data, most recent data, has been on the soft side. So I think as long as the slowdown in China is modest, which is what our forecast would indicate, and as long as US bond yields stay within a manageable range, which again is the house view, we don't see bond yields in the US going any higher than 2.7% by the end of next year. I think it'll just be a question of when you start to see the buying coming back in. And we're certainly optimistic for EM equities next year, although I don't think we're going to have another 30% year. It feels to us like more of a 10% year next year, but we're definitely constructive.
And where would India rank in your pecking order right now?
We're still overweight. Now, I think the way to look at it, frankly, is that, and Gautam will talk about this, of course, you've seen some local liquidity helping to drive the markets. We think that GEMS investors are beginning to reduce their overweights in India. And I think it's a question of sort of stacking up the short-term pressure on growth, which is clearly there, and will that recover, which is obviously what we think will happen. Tanvi will talk about that, I'm sure. How challenged the short-term economy is compared to the longer-term story, which is still very good. I mean, if you look at it over the long term, India is still the best growth story in the emerging market index. I think that's what people are looking at. They're wondering at what point do you start to, eventually come back into the market. But frankly, it's pretty expensive right now. But we're still long-term overweight.
Okay, Gautam, I'll come back to you since we're discussing the economy and slowdown. Tanvi, your sense of where we are right now in terms of economy, you recently released a note as well. What kind of growth do you see once this near-term, GST overhang is over?
Okay, so if you look at the way we are looking at Indian economy right now, we believe that 2017 and at least over the last 12 months have been a period of unprecedented reform. So we saw GST getting implemented, which is the biggest tax reform in India on the indirect side. We saw demonetization, which is a move towards digitalization and formalization of the economy. And finally, we saw steps taken to try to resolve the stress asset situation of the banking system. So deleveraging is continuing. So we are at 6.6% GDP growth for this year, which is FY18. However, we think that most of the disruption in economic activity is now behind us. We are expecting growth to pick up or recover to 7.4% in FY19. So we are quite optimistic on the overall growth front. I think the key is not whether the GDP growth will recover from 6.5 to 7. The key is whether 7 will go to 7.5 and higher. And I think for that, the most important thing which I need to see is the investment cycle recovery.
So do you think there are upside risks to your GDP target instead of downside risks?
As of now, looking at where the oil is, and we have oil at 55 a barrel for the full year average in our forecast. If oil sustains at a higher level where we are seeing right now, then I think there are more downside than upside risk at the moment.
Okay.
So that is for FY19.
In terms of oil, how big is that risk for the Indian market? We've seen 64 and now it's cooled off a bit. If it starts to go above, say, 70, in that case, would you be cutting your estimates?
So if oil remains around $60 a barrel, my macro stability risk will widen, be it inflation, current account deficit, fiscal deficit, but I won't be as much concerned as I would be. But if oil crosses 70, I think the impact on my macro stability risk will be much higher. And India has been enjoying this high growth, low inflation, and was able to do a lot of reforms because we were getting a lot of bounty from the low oil prices. And we are a net oil importer. So if oil prices sustain higher, we are definitely at a disadvantage.
Okay, fair point. So now we have the macro picture and, of course, the global picture, Gautam. How's the domestic picture looking? Because, there's this liquidity argument that every month we are seeing, 20,000 crores. Where will this money go? And, of course, there's the foreigner selling as well. And India is an expensive market. So put this all together for us and tell us your view on the market.
So I think the key delta here is two parts. One is whether earnings recover strongly enough in terms of what the markets are pricing in or expecting. And secondly, whether the local liquidity can sustain at these levels beyond this year. So the first part, earnings recovery, our top-down view is we'll still see earnings cuts. Very simplistically, the current earnings forecasts imply 20% earnings growth in second half of fiscal 18, which despite the optical base of demonetization, in our view is very difficult to be met, because in a way it presumes that we're not talking just about an optical low base, but a stronger economic recovery, more than possibly what even Tanvi is forecasting. And secondly, if you look at next year, fiscal year 19, so Tanvi's forecast is 7.4%, but that's very similar to what we saw GDP growth for the last 3-4 years. And we all know where the earnings growth numbers were at that level of GDP growth forecast. So our top-down forecast is 13% for fiscal year 19. So we are building in some earnings recovery, incorporating a soft economic recovery, but nothing great, not where the markets are pricing in. So market expectations are that next year, it will kind of a Goldilocks scenario where government will possibly stimulate growth, at the same time not hurt in terms of macro stability or inflation, which is difficult.
So at index level, you're still not a buyer. You would want to wait for some
The risk reward is
correction.
definitely not attractive at these levels.
Okay, and
but the local flow obviously is a strong support.
Exactly. You got to put the valuations in context with the flows and also the interest rates. So it's not necessary that the market goes to the level that you would expect, but what would be a good level? Where do you think the risk reward would again start turning favorable?
So again, we don't have a formal forecast for next year for Nifty targets, but even for for calendar year 17, our upside scenario was 10,000. And if you're looking at 10-12% earnings growth next year, you would like to buy markets below that upside scenario to give you some comfort in terms of downside, specifically given how interest rates, the 10-year yields have moved, which kind of dilutes the entire cost of capital argument for valuations. So risk reward definitely not here.